All right. With hobbies out of the way, we got another business versus personal problem we got to deal with. And this isn't the last one, but it is the last one we'll deal with in this chapter, thankfully. So the next one that would arise is using one of your rooms in your home as an office, so the home office deduction. This is a bigger scope, though. This is about when you have a home and you use it both as your home and both as some sort of rental property. So, first, what is a home? Well, that's a dwelling unit, and it can be a home, a condo, a mobile home, or a boat, or all sorts of other similar property. It doesn't have to be a house, a single-family house like we think about it. And a home can be used solely for personal use, right? That's how most of us use our homes. It could be a mixture of personal and rental use. So that could be like a vacation home where, I spend some time there, but I also rent it out most of the year. Or it can be solely rental use, where I simply just own a home and I just rent it out for rental income. And as you can imagine, this creates degrees of activity on the business versus personal continuum. And so the IRS has to come up with a way of determining how to treat when we might use our home, our dwelling unit, as a rental. So these rules come up with three categories, okay? And this is true when the home is rented for any period of time during the tax year, because otherwise it is simply just your dwelling unit, right? There's no business element to it. So let me tell you how I describe them and then how the book describes them as well. So number one, primarily personal use. This is a residence that has hardly any rental use at all. And so we're going to have to define what that minimum is. And let's skip down to number three, primarily rental use. So this is a home that you hardly use at all for personal purposes whatsoever. So those are the two bookends. Now remember, we have to use it at least some part for rent, or else it's just a home. And then there's an in-between category, and that's a residence that has significant rental use, but doesn't rise to primarily rental use. So you can see that we're going to have to come up with some measures, some tests, to establish what falls into each of these three categories. And the classifications are significant because they are going to affect the amount of deduction and perhaps even the amount of loss you can recognize. Okay, so the way that we're going to define these three classifications is almost exclusively based on how many days we use the home as either a rental property or a personal. And so what we need to understand is what are personal use days, because I think rental days are pretty obvious. But so a personal use day is any day that the taxpayer or the owner or other owner stays in the home. So obviously, if you're the owner and you stay there, that's personal use day. If a relative of yours stays in the home, that is a personal day, even if the relative is paying fair market value. So that's a pretty strict rule, but there is an exception. And the exception is if that home is the relative's principal residence. So they're not going to your ski condo in Park City and staying for a few days, even if they're paying fair market value. This is, no, I'm actually renting a home 365 days a year to my relative, and that's their principal residence as a result. Then those aren't personal days. Any day you stay in a home under a vacation home exchange or a swap, and any day you rent the property out for less than its fair market value, that's considered a personal day. Rental days are any days that you rent the property at fair market value, of course not including those accepted from above, or any day you go there to repair or maintain the home for its rental use. So if you're between tenants and you go in and repaint, the walls or replace something or fix the toilet or whatever it might be, and as a result you stay there, well, that's fine, right? That's not considered a personal use day. That's another rental day. Okay, so now we know how to count days. What are the tests, right? Oh, sorry, one more. the days the home is available for rent but not rented are neither personal days nor rental days. So think of those as like days that don't exist, even though that's crazy. Of course, those days do exist. All right, a couple other rules we need to understand because we haven't made it to itemized deductions, but we keep running into these issues that deal with itemized deductions. And they're important for understanding how expenses are deducted when you have a multi-use dwelling. So the first is you get a mortgage interest deduction for interest that you pay on debt secured by your principal residence. And what you will find is that you can actually have more than one principal residence. So you can actually have two principal residences. And you can take an itemized deduction for the mortgage interest that you pay on those. And the second is that your real property taxes on your principal residence are also deductible as an itemized deduction. Now, of course, we know there's a SALT cap out there, and if you don't know that, it's because you haven't been in the U.S. for long enough. But point of large contention, especially in high-tax states like California, where there's a $10,000 cap on the amount of state and local taxes that you can deduct. Okay, and as I mentioned, a second home can also qualify as a residence for purposes of the above two deductions. Okay, and the reason this is important is because if I have a home and I'm using it part for rental and part for personal, then I may need to bifurcate those two expenses, mortgage interest and property taxes, into their personal use portion, which might be eligible for an itemized deduction if I'm taking the itemized deductions, or the business deduction associated with the business portion of the use of that home. Okay, finally we're getting to the point where we can classify. What are the tests? Well, we had one that said it's primarily personal use. Now remember, we have to rent it for at least some days, or it's just a dwelling, right? And then there's no bifurcation, there's no anything. It's just your personal home. There's no business element to it at all. So primarily personal use means the taxpayer must have lived in the home for at least 15 days. So you have to have lived there for at least 15 days. And you've rented it out for 14 days or less. So as long as you don't rent it out for more than 2 weeks, the rules that apply to you are all your rental income is excluded from your gross income. However, no rental expenses, except for those that are personal anyway, like the home mortgage interest and real estate taxes, are deductible. So I like to refer to this as kind of the Super Bowl exception. So Mr. Hand owns and lives in a condo in LA, and it's within walking distance of SoFi Stadium. So in January of 22, Mr. Hand is going to take a vacation to Hawaii and rent out his condo during Super Bowl week. And because he's close by, he can rent it for this atrocious amount of $4,000 a week because all these people come into LA and they want to see the Super Bowl. And they'd rather stay at a place than a hotel room. So Mr. Hand lives in the home for at least 15 days. Yeah, no question. His rental is less than 14 days, right? Because it's 2 weeks. It's only 14. That means that $4,000 worth of income is totally excluded. It is tax-free. However, to the extent Mr. Hand pays a fee for cleaning or anything else related to that rental part, like advertising, etc., those expenses are not deductible. However, he can, of course, deduct his interest and property taxes as an itemized deduction if he was going to do so anyway. All right, let's get on to the next two categories. These two are a little more complicated because this one's fairly straightforward, right? You rent it for 2 weeks or less, you don't recognize anything. Okay, category 3. Remember, that's our primarily rental use. So we have to rent it for more than 15 days because, of course, if we rent it for fewer than 15 days, we're back in category 1. So we've rented it for more than 15 days, and our personal use is less than the greater of two items. Either it's less than 15 days, or it's less than 10% of the rented days. So, and you choose the greater of those two. Okay, so that leaves us with what is in between. right? So category 2, what is in between? Well, again, you got to rent it for more than 15 days or else you're back in category 1. Now the personal use is more than the greater of 14 days, right? Because it's got to be more than 14, so I got to be into 15, or 10% of rented days, right? So what's happening is personal use has increased. It's more than that cutoff test, right? Whereas suppose in category 3, it was less than that cutoff test. Okay, so I think the only way to understand this fully is to go through some examples. So let's go through some examples. All right. So I've taken the information on the slide and I've put it in Excel because, obviously I'm an accountant, so I love Excel. So let's start with the first one and run it through the first test, right? Which is, did we rent it for more than 15 days? All right, so rented days, 14, personal use, 351. Was it rented for more than 15 days? And really that should be more than 14 days, right? No, it was rented exactly 14 days. So we'd say no to that, which means none of the other tests apply. That is a category 1 item. All right, let's go on to the next one. So was it rented for more than 14 days? And yeah, if I scan over here and look at the days rented, all the rest of these were rented for more than 14 days. And so for sure, I'm in a land where I need to worry about the rental, the other tests, right? The personal use test. Okay, so how much personal use did I have with iteration B? Well, I had no personal use. All right, what is 10% of rented days? Well, 10% of rented days is the number of days rented times 0.1, so 36.5. 14 days is simply 14 days. Which one is greater, right? Because I compare it to the greater of the two. Well, 36.5 is greater, so we could even put a formula in if we wanted to. All right. And then we say, okay, well, compare the personal use days to the greater of those two. Is it more or less? Oh, it is much less, right? Because it's 0. Well, that makes that a category 3, right? Category 3 represented primarily rental use. All right, let's go on to the next one. So I've got 350 days rented, 15 days of personal use. So let's put the 15 days of personal use in. What is the number of rental days? Well, that's 10%. So we can just drag our formula down. 10% of 350 is 35. That should be 14 days, which is the greater of the two. That's 35. Did I have personal use for more than the greater of those two? Well, no, I did not. Category 3. All right, let's go on to the next one where it looks like I used it a bit more for personal use. I'm up to 35 days. What is the percent of rental days? Well, that's 33 times 10%. Sorry, 330 times 10%, or 33 days. 14 remains 14 as far as I can tell. Okay, now, does my personal use exceed the greater of those two? Well, let's see. The greater of those two is now 33, and it does exceed the greater of those two, making that a category 2. On to the next one. Personal use is 15 days. 10% of rental days is 12. 14, what's the greater of the two? 14. Does my personal use exceed 14 days? It does. Category 2. All right, last one. Personal use, 15 days. 10% of rental days looks like 15.5 days versus 14. Which one is greater? 15.5. Does my personal use exceed the greater of the two? It does not. Therefore, I am a category 3. Okay, those are the tests that you go through to determine whether or not you are classified as either a category 1, primarily personal use, category 3, primarily rental use, or in between. All right, let's go back so we can talk about how the rules differ between these classifications. So we learned already, if you're in category 1, what do? Well, you do nothing. Right? You don't reflect the gross income. You don't deduct any of those rental expenses. You just treat it like it's your home, as if you have no rental at all. If you are in category 2, so remember, category 2 is in between. So you're renting it, but your personal use exceeds the greater of those two measures. Well, the first thing you have to do is allocate. So you include all the rental revenue and gross income, and then you're going to allocate your expenses between personal use and between rental use. And if the property is used even just one day of personal use, which of course it's going to exceed that, you must allocate your expenses. And we're going to allocate these expenses in 3 tiers. And yeah, the tiers matter. Tier 1, Tier 2, or Tier 3. So Tier 1, and by the way, Tier 1, 2, and 3, those are legitimate tax terms, right? You will see those used. The category 1, 2, and 3, totally made up by me. All right, so Tier 1, expenses to get tenants and interest and property taxes. So think of Tier 1 as being direct expenses, right? So that is costs that are associated solely with the rental of that property. So you place an ad to get renters. You place an ad in VRBO. You pay a commission to VRBO, right? Which is vacation rentals by owner, right? So you pay fees. That is solely associated with getting your tenants. And as a result, that's considered a direct expense and would be a Tier 1 expense along with that mortgage interest and your property taxes. And we know those are unique, of course, because you can deduct them as itemized deductions. Tier 3, I'm going to skip down. Tier 3 is depreciation, right? That's it. All that goes into Tier 3 is depreciation, making Tier 2 every other expense that isn't Tier 1 and isn't Tier 3. Okay, so we're going to get to how to categorize those in the tiers in a second, but at least for right now, that's all we need to know. Category 3 says, okay, well, remember, we're primarily rental, but if I have any personal use, even if it's not greater than those 2 limits, I still need to do the allocation. The difference is there's going to be no expense limitation. So in category 2, the total of your expenses, for the most part, this is the general rule, is the amount of revenue you generated from that rental. Okay, so you cannot create a loss on your rental if you're in category 2. And the tax rules are written that way. It's like, look, your personal use is too high. Why should I let you incur a loss when you're not running a risky business? Whereas category 3, remember, that's primarily rental. We're saying, look, your personal use is so small that it hardly matters at all. We'll let you still have to allocate, but we'll actually let you incur a rental loss on that property. Now, we'll find that the passive loss limitations may restrict that ability to take that loss, but that is outside of these 3 limitations. Okay, so again, category 2, expenses allocated to rental use are deductible only to the extent of your gross rental income after deducting those Tier 1 expenses, which means generally speaking, you cannot incur a loss for what we categorize as a vacation home. General rule is your expenses are allocated based on the number of days used in each activity over the total days used. Okay, so this is a unique calculation. The number of days used for each activity, well, that's personal use and rental use over the total days of personal use and rental use. So those days that you're not using it and it's not rented, remember, those don't count. Those are non-existent days for this allocation calculation. Now, there is a separate method because, of course, there's exceptions to everything in tax, right? There's an exception that says you can actually allocate your Tier 1 expenses, interest and property taxes, based on total days in the denominator instead of just the number of days used. In any event, your expenses are always deducted in tier order. Tier 1 first, Tier 2 second, Tier 3 third, assuming you have enough gross rental income to deduct it. Okay, so there's no question that the only way to do this is to think about an example. So let's do an example. So at the beginning of the year, Mr. Hand and his family purchased a vacation home in his home state of Hawaii for $400,000. They paid $100,000 down, financed the rest with a 6% mortgage secured by the home. During the year, they used the home for personal purposes for 30 days and rented the home for 200 days, receiving $37,500 in rental income and incurring $500 of rental advertising expenses. The other expenses for this vacation home are listed below. And you can see interest, property taxes, utilities, repairs, insurance, maintenance, and depreciation. How are we going to allocate their expenses to the rental use under both the IRS and tax court's methods? Well, before we even get there, we need to determine what is the classification of this property, because we use it part for rental and part for personal. Okay, do we rent it for more than 14 days? Yeah, we rented it for 200 days. Category 1 is completely off the table. Okay, next step is let's calculate the greater of 10% of the days we rented it. That would be 20 or 14 days. Well, 20 is more than 14. So our benchmark measure is 20 days. Okay, how many personal days did we have? 30. Is that greater than 20? Yes. We are a category 2. So we know that our expenses in total are going to be limited to the gross rental income that we derive from this property. Okay, now let's move on to our next step. So we got this $37,500 of gross rental income. And I've listed on the left all of our expenses, and note that I've listed them in tier order. So tier 1, advertising, right? That's a direct expense. Interest and property taxes, which are classified as tier 1. Skip down to tier 3, depreciation. That's the only tier 3. Everything else, so utilities, repairs, insurance, maintenance, those are all tier 2 expenses. So again, I've structured these, and we can see, look, my total expenses, $54.39, clearly exceed my gross rental income. So already I'm thinking I may have a limitation issue. But remember, the first step I have to do is allocate them. So we're going to use what's called the IRS method first, which is the typical method, which says everything is based on the number of rental days divided by the total number of days used. Recall that we rented it for 200 days. We used it for 30 days. So we're taking 200 divided by 230. That is our pro rata allocation amount. Okay, well, let's apply that pro rata allocation to all of our expenses. Oh, wait, we didn't allocate advertising, right? Remember that direct cost. Why didn't we allocate advertising? Well, because that's a direct expense. No part of that is associated with personal use. And so as a result, 100% of that gets allocated. But then we get to interest. Well, we're going to allocate 20 over 23. Property taxes, allocate 20 over 23. And we're going to allocate each and every of these additional items 20 over 23 until we get to depreciation. And the reason that we're fixated on depreciation is because, remember, we've got $37,500 of gross rental income. Okay, when we deduct our total allocated tier 1 expenses, that's $20,500. When we deduct our total allocated tier 2 expenses, that's another $11,304. We only have $56.96 left of gross rental income to offset. Well, unfortunately, 20/23 of $13,939 is more than $56.96, which means that our tier 3 expenses are limited to $56.96. Therefore, our total expenses are only $37,500 because we are not eligible to take a loss on this property. We're not eligible to take a loss. What happens to that remaining depreciation we can't deduct? We can carry it forward in hopes that we could offset next year's gross rental income with that amount. Okay, that's the IRS method. Now let's look at the tax court method. And remember, the tax court method said, hey, for tier 1 only, you can use the total number of days in the year. Okay, so when we look at our allocation of advertising, that's direct, it's 100%. But notice that the amount of interest and property taxes are now different. That allocation is much lower than it was before. Why? Well, it's only 20 out of 36.5 instead of 20 out of 23. But notice that once we get to tier 2, our allocations are the same, right? So we go back to the IRS method because the tax court method can only be used for interest and property taxes. All right. So now we get to the bottom and we say, okay, well, how much left do I have? All right. Well, once I've deducted tier 1 and tier 2, I have $13,093 left, but I can only allocate 12,121 because that's the 20/23 of 13,939. So in this case, I actually get to deduct all of my depreciation. Okay, well, no kidding, Steve. We get it because you were not eligible to deduct all your interest and property taxes. How do you think this is a win? Well, remember, if I am itemizing, what do I do with the other portion of interest and property taxes? Well, if I'm taking an itemized deduction, I get to deduct it anyhow. So the tax court method can, but isn't always, can be advantageous if you're trying to maximize the amount of deduction you can take. Because the bifurcated amounts under the IRS method, more was going towards the rental property. And as a result, my depreciation deduction was limited. But now that I've pushed that personal use over into itemized deductions, my depreciation is no longer limited. And as a result, I can deduct all of it. Now, I do reflect a little bit of income here, but in theory, it is offset by the greater deduction for itemized deductions. Obviously, if I don't itemize deductions, it doesn't make any sense to use the tax court method. Okay. Wow, that was a long way to go to get through a category 2 allocation. But you can see that there's a lot tied up in there, right? There's a lot of nuanced rules that have to be unpacked when you think about doing a rental home. All right, category 3, primarily rental use. Again, rental days exceed 14 because they have to. Personal use days are the less than, the greater of 14 or less than 10% of rental days. Okay, so that we end up in this primary use category. What does it mean? Well, it means you get to deduct all income and deduct all of your rental expenses post allocation, right? You still have to allocate them. Now, here's something that's weird about this particular one. Remember that tier 1 expenses, property taxes and interest, well, when you fall into category 3, that is no longer considered your residence. And if it's not your residence, then you are not eligible to deduct mortgage interest. So you can generally still deduct your real property taxes. However, whatever personal portion of interest is allocated to the home, you may not deduct as an itemized deduction. Now, I will tell you, the vast majority of taxpayers just deduct that interest anyway, because they don't think about it. All right, assume instead that the Hand family did not use that home for personal purposes at all. They said, you know what, I bought it, it's just an investment, we're gonna rent it out. Hawaii is just too expensive to get to, it takes too long to get there, but they have the same gross rental income and the same expenses. Okay, how much of those expenses can they deduct now? Well, because their personal use is 0 and it's primarily rental, they can actually deduct all of their expenses. Now, that doesn't mean that that loss is deductible. It could be limited under the passive activity loss limitations, which we will get to eventually. All right. Okay, so I had to question whether or not this slide even belonged in here, and I'm going to say it does not. We are going to, oh man, I hate to defer it, right? Because it belongs here, but we're gonna inject this into the passive loss discussion when we get to that chapter. So that's gonna end this video right here.